1 minute. Um, just remind me after the class, okay, Aditya? Just remind me after the class is over. All right, we can
Sure,
we.
sir.
Okay, this is recording now, so this should take care of the problem. It will record the screen, and then I'll upload it to YouTube, and that'll be and yeah, so that'll take care of the problem. Okay, so yeah, so this is a very important point. A couple of very important points that you need to understand for your own future development. Very very important points. Generally not taught in business schools, but tremendously important in any kind of prediction business. So the question I was asking you is, I said there are a couple of important principles and statistics that are relevant here, which Graham fails to understand, which these quant traders have a very good grasp of, which is why Rentech has been so successful, and they have a very low success rate actually, maybe just over 50% kind of success rate, but they do large numbers of trades and across many different asset classes. And so I was talking about a couple of statistical principles that you guys should be aware of. And I started lighting law. Now, can anyone fill it out? What do you think I'm going to talk about? Can anyone predict? I'm saying these are principles and statistics that everyone needs to try and understand. It's a little difficult to understand, conceptually a little bit complex, but you should understand it, especially if you're going to go into analytics and all that, and those kinds of every area actually. You need to understand this as a general. I mean, even in business, in all areas of business. Couple of important. So anybody wants to fill in the blanks? What am I going to write about in stats? Yes, anyone? No? Okay. You have not heard about this. Anybody wants to fill out? Now? More clues? Now? Yes? No? Okay. Law of large numbers. Okay. You need to understand this. Dig it up. There are some very good stats courses on MIT. I will give you some very important to understand. Make sure that you're because you can never escape from this. Okay. If you go into industry, you'll find I have seen people from industry coming and presenting during our seminars and talking about how many people are doing analytics. They just know how to use the software, but they don't have a good understanding of statistics. So analytics is really requires, it's just a combination of all your big data analytics and all that. It's a combination of statistics and programming. That's basically what it is. Okay, so you have to have a good grasp of statistics, and of course you can continuously improve your programming. But you should start out with a good grasp of statistics. I will give you a couple of resources. So you need to understand the law of large numbers. You also need to understand, what else am I going to talk about, guys? Can anyone predict? Which means you have not heard of the law of large numbers. Okay, because I was giving you so many hints and nobody could fill in the blanks. Another thing I'm going to write from the domain of statistics. Can anyone predict what I'm going to write? No? Now? Anyone? No one? Now? No? This is like giving clues in Jeopardy.
Central limit theorem.
Correct. Very good.
Central
So,
limit theorem.
yeah. So, central limit theorem. Okay. You look up good statistics textbooks. There are many you can find on PDF Drive, etc. Good. Look up good statistics textbooks. There are many good. Go to MIT Open Courseware. They have very good statistics courses. They explain. I've seen a course on the MIT Open Courseware website, or you can even search for MIT Open Courseware on YouTube. There'll be good stats courses from MIT. There is another very good stats source. I'm going to give it to you. Please make sure you study your stats from these kind of quality sources. Okay. Let me just look it up. Okay. Um, I was just telling Utsav the other day because he was talking about some analytics stuff. Uh, so he happens to be already aware of this. Um, Let me just make it's a very good stats website. It's an interactive website. Yeah, I think there's okay. You find it. I know this. I know this guy. Okay, so you just find it here. Um, you'll find his lectures are also on YouTube. That, yeah, this is actually what I'm talking about. Okay, now I'm going to paste this here, then you guys take care of the rest. So this is all stuff that you have to do on your own. All right, this is very, very important stuff. You need to educate yourself. So this is the home page of this guy. Let me bring it here. Okay, Philip Stark. He's a UC Berkeley prof. He's expert. He's an expert witness in many cases on statistics. This is the text I'm referring to. Okay, this is not really related to investing, but it's very good because these days everybody's talking about analytics, but many people don't have a good understanding of. So there you have. Okay, table of contents. You got everything. It's a beautiful statistics textbook. Make sure you do it. Make sure you understand all your basics inside out. Stats is a very difficult subject because it's, in addition to maths, it's also conceptual. So you need to be decent in maths, but you also need, stats is mainly a conceptual subject. Okay, there's a maths is used for derivation of formulas and all that, but it's mainly a conceptual subject. It's a very difficult subject, so make sure your stats is very, very solid. Okay, at least basic concepts like this. Use these kind of quality textbooks and take care of it. Okay, this I will not be able to teach you this, but as like in many other areas, I'm going to give you certain pointers as to what you need to learn, and therefore you take care of it and run with the ball yourself. So you have to take care of that. Okay, so this is, now I can wipe out this thing. I think, yeah, because I'm pretty sure the recording is not available because I launched it from my personal email address from this page. That's why it's not available. So anyway, we'll leave it. What I'll do is, for whatever it's worth, I'll just teach it from my. Yeah, we're here. So what I'll do is I'll just close this. Right. Okay. So these are the two things you need to understand. So this is it's a very important point actually. Although he talks about all this high turnover being a bad thing, that's not actually true. Okay, there are important statistical principles that feed the high turnover strategy, and there are very, very profitable high frequency trading firms like Virtue Financial and this. So you need to understand this, that there are many mistakes in this book, although it's considered an investment classic. So that's why hopefully my annotations and my commentary on the book will help you, so that you don't just swallow everything in the book, and you're aware of what are the problem areas in what the book is saying. Okay, so you have to make sure you take care of your stats education and give yourself a good stats foundation, and that'll give you an advantage in the industry, because many people are not good in stats, although they're using software and they're working in analytics. So I've heard industry people actually complaining about this, because they don't understand the stats elements of it. So I will take this link also and post it here in case there's any confusion. Yeah, that's the textbook. All right. Okay. Now let's go on to the rest of the book. So we're on we're going to page 56 now. No, we should not go straight to page 56. We see where we ended. Page 51 is where we ended. Okay, we'll just go through the pages. 51 towards the end is where he had this average holding period is where he's talking about all this stuff, and he's talking about how brokerage firms basically shifted to high frequency trading. Obviously this is in the interest, you have to understand all this. Okay, when you listen to news, when you are reading something, always understand where that person is coming from and what his incentives are. So obviously a broker wants you to trade more actively, because the more actively you trade, the more brokerage that is being generated for him. He doesn't really care about whether you're making money or not, because that's not how he's getting paid. He's getting paid according to the volume of your transactions. So when somebody's giving you advice, don't just blindly follow what they're saying. Look at what their incentives are, and what kind of so look at what their incentives are, and accordingly filter out what they're saying. Okay, so understand that everybody will try to basically act in their own interest, and therefore you should be able to judiciously filter out the advice that you're getting from various sources. So yeah, brokerages obviously will try to get you to trade actively. He's talking about how the average holding period has gone down, and he's complaining about that. So it's more on the same theme, okay, which is not necessarily, as you know, is not necessarily a bad thing, as I've just explained to you. And but he's just, since he's picked up on the theme, he's just talking about it. So we are going to go through the text. We're not skipping any parts of the text, even though we feel this is not the correct focus. So he's just talking about how it was made into a video game, etc. Obviously, people have to make, nowadays, this, I mean, I wonder what he would say if he was writing the book today, because nowadays you have Robinhood allowing people to trade in fractional shares. There is commission-free trading, actually. Robinhood is commission-free trading, and you can trade in fractional shares. Like, you don't even have to trade in odd lots of 100 shares. So there's a lot of, basically they're trying to make it. And nowadays you have people on TikTok. If you're watching Bloomberg Technology, you'll see many of these discussions, that there are many TikTok influencers who are advising people on mutual funds. So you are learning about mutual funds in like short videos. That's not the way to learn about it, but because I guess people have short attention spans these days, so the only thing you can communicate to them about is whatever you can say in a few minutes. So that's or a few seconds. That's basically what the situation is today. So he's just so he would be even more scandalized. Graham would be if he were here today, talking about looking at TikTok influencers, who are some of them are actually apparently making like $500,000 a year. So maybe instead of looking for a job, if you try to become a TikTok influencer, that would be more profitable. So yeah, so all this stuff which they were trying to glamorize online trading doesn't take a lot of effort. Yeah, obviously if you do that, if you want to make more people come in and do this stuff, you got to make sure that, because nobody wants to work that hard, so you got to make sure that you project this as something which doesn't require a lot of work. So that's what Graham is complaining about. Okay, so this is just the same stuff, so I'm just going to go through it, how they try to right. So this is obviously, so many people are actually doing this even today, what Juno did. This is really a plan to actually offers everything for free, and then also spend more on advertising. This is what many startups are doing even today. And then of course you have, this is the advertising model, and then you try to earn money for on the advertising, etc. So this is the typical internet advertising model. And yeah, so you have all this, and then you can see here that this is a funny incident where people were buying Temco actually, but actually they were buying Temco because they mistook the ticker of Temco for what they actually wanted to buy was Ticketmaster Online, which had a very similar ticker. So this is of course kind of ridiculous. This should not happen. You should know what ticker you're trading in. So this is a very famous quote from Oscar Wilde. It comes from an Oscar Wilde play called Lady Windermere's Fan. So so you should know the meaning of the statement, okay? That essentially, again, this is the kind of, in investing we would relate this to the difference between price and value. So the reason that you can see that you can know the price of everything is because I don't think I can copy and paste, but I'll just briefly mention in page 54 maybe, here page 54, I'll just briefly mention this. Okay, Oscar Wilde. You know who Oscar Wilde is, right? The Irish playwright. Okay, so Oscar Wilde. So this statement about price, price of everything, but value of nothing. So this is actually about it's a statement about people who are not capable of appreciating the true value of certain things. But here in investing, we use it in a context of typical distinction between price and fair value. So that's basically what it is, because the price of everything, because the price of everything is easy to understand because you can just look up a chart and see what the price is. So it's easy to figure out the price. But in order to find out the value, obviously you have to do some research, do some thinking about how you project the earnings or the returns from that asset. So doing a fair value analysis takes a lot of time. Figuring out what the price is very easy. Just look at the market price websites, and you can get the price. Okay, so that's why that's why we use this expression. That many people know the price of everything, but the value of nothing. But then you have to also be careful not to glamorize value too much, because value itself is quite subjective. So your value, while you might have spent a lot of time doing it, your value doesn't necessarily have anything special about it. Okay, even if you happen to be Warren Buffett, as we saw in the case of Kraft Heinz, Buffett made a nearly $9 billion mistake. So even Buffett makes that big, mistakes of that magnitude. So nobody's value estimate is anything special. So anybody could be wrong at any point of time. So that's something that you also have to remember. So this is basically the difference between the context in which we talk about. We use this expression from Oscar Wilde. So you should know this, because sometimes it's quite a commonly used expression. So okay, we can close this home page now. Right. Okay. So yeah. So as far as this is concerned, let's go back to the book. Okay. Yeah. So art and science, and you'll see that Ashwat Damodaran. Those videos are actually quite good. I think I've already told you to follow the Damodaran videos on YouTube. So he does a pretty good job, because he's not a typical academic. He looks at the real world as well, but I think he also has a typical Graham kind of focus. Too much focus on value, but then value itself is subjective, and not sufficiently. I would say the problem with Damodaran's approach, the only problem is that he's not sufficiently flexible in terms of, in the sense that he does not really give that much importance to the market, and does not try to follow the market be close to the market at all times, which is a discipline that everyone who actually operates in the market needs to have, because you cannot afford to argue with the market. This is the difference between market professionals and academics. Academics can afford to argue with the market because they never trade. So, but if you trade, if you're managing money or you're managing risk for a corporation, you can't afford to argue with the market too much. You have to be, if the market is moving away from what you thought was the fair value, at some point of time you have to forget about your fair value and take action, because as the market price moves, you're going to keep losing money. So therefore, so those who actually operate in the market can't afford to be, sort of, how should we say it, so sort of insensitive to market price movements, which is what happens with a lot of these people, even with Damodaran actually. They cling to their vision of value, and they. So I think I should mention this here. Okay, this is also it's on page 54. Okay, yeah, it's on the same page. So I'll mention this point. There's another important quote actually that you understand, that so you have to always remember the market is always right. The market is always right, like the customer is always right. So you always assume that the market is right, otherwise you can lose too much money. So the only people who don't believe in this kind of principle is people like academics, who never have to actually trade, who never have to actually manage any money or any risk books. So they can afford to just sit in a ivory tower and say, well, the market is overvalued, the market is undervalued, whatever. But the market is always right, and the market doesn't really care about your estimate of fair value. And here there's another important point. Another important. Let's say anyone's estimate of fair value. So your estimate of fair value is a subjective estimate. If the market is moving away from your estimate of fair value, at some point of time, pretty quickly, hopefully, you should just forget about your estimate and just admit that you're wrong and close out your positions, because you can't afford to fight with the market. It will have disastrous consequences. So the market doesn't care about anyone's estimate of fair value. So if you read, I've asked you to read the book by Jack Schwager, this Market Wizards books. In the first Market Wizards book, he gives a quote from Saddam Hussein, I think related to Saddam Hussein's loss in Iraq. So when he went into Kuwait and the Americans asked him to go back, he didn't listen. So eventually he basically lost his life, right? So he lost his entire kingdom and he lost his life. So the moral of the story is, so I should write that as well, about anyone's estimate of fair value. Some important things which are in the nature of slogans, but very, very important to remember, okay? That if you can't, this is right in the beginning of the Jack Schwager book, Market Wizards. If you see that dedication page, if you can't take a small loss, okay, so the idea is that when you have a small loss, you should take it then and cut your position. You can see the market is going away from your estimate of fair value, and therefore you should just accept that you're wrong and cut your losses. So if you can't take a small loss, then sooner or later you will, as we like to say, you will take the mother of all losses, which means you're basically going to get wiped out. This is what happened to Saddam Hussein. I think this quote came out around the time that this Iraq disaster happened for Saddam Hussein. So this is during the time of Bush, when Bush Senior was the U.S. president. Okay, so at that time I had just joined the industry. I remember I was sitting in the Amex Bank Bombay trading room. That was a holiday for us in Bombay, but I was in the trading room because I wanted to see the European action. So, and of course we didn't know what was going to happen. And then that's when Saddam Hussein went into Kuwait, and I saw the news coming over the Reuters ticker that Iraq invades, Iraqi army moves into Kuwait, and then the gold price shot up. Then the dollar also shot up for a few hours, but then pretty soon, by the end of the day, both gold and the dollar had started to decline and were actually below the levels when the news came in. So all this stuff happened when I just joined the industry. So this would have been about 1991. 91 I think is when this happened. So this is so I still remember that stuff. So this is what happened. So this the Iraqi invasion of Kuwait. And now the important quote from Maynard Keynes, which I want to give you, is all of the same theme. Okay, all of this is on the same theme, which is the market can remain irrational for longer than you can remain solvent. Okay, right. This quote is attributed to Maynard Keynes, so I'll just make sure there's no confusion. This is. Have you heard of Keynes? Have you guys heard of Keynes? Anyone has heard of Keynes? No one did economics. Okay, so John Maynard Keynes is a British economist, but he was also a money manager. He lost a fair bit of money early on, but then later on he managed a couple of British. I don't know if it's Oxford. I'm not sure whether it's Oxford or Cambridge, but it's one of those two. So he had a couple of college endowment funds from Oxford or Cambridge that he managed, and he produced a fairly good return. So Keynes again was a slightly unusual type of academic in that he was also a money manager, and he did pretty well in his later years as a money manager. So it's a very unusual kind of academic. So Maynard Keynes is the guy that is associated with the Keynesian theory, etc., which basically argues for. I mean, he didn't really mean this, but nowadays people say, when they say Keynesian economics, they mean that the government should interfere in the economy and, basically do counter-cyclical fiscal policy. But this is basically, this quote is from Keynes's experiences as an investor. Yeah, there's some kind of okay, never mind. So this is very important to understand again, that the market can remain irrational. So remember what is meant by irrational when we say the market is irrational. Can anyone tell me? I've mentioned this to you before. What do we mean when we say that the market is irrational? When somebody is saying, let's say somebody is saying that the market is irrational, what is he trying to indicate? It's a very specific kind of it has a very specific kind of implication. When somebody says that the market is irrational, or let's say somebody who believes in the price versus fair value paradigm says that the market is irrational, what does it mean? What is he actually trying to indicate? Can anyone answer? No? Okay. So here, irrational means you should look up your notes. I'm pretty sure I've mentioned this before in when we were discussing the EMH, right? The efficient market hypothesis. So essentially, when people who believe in the price versus fair value paradigm, when they are talking about when they say the market is irrational, what they mean is that the market price is far away from my estimate of fair value. Okay, that's basically what it means. So if you look at, let's say we just have, let's we pull up the this is just a federal funds rate. Okay, this is a highly managed interest rate, but it doesn't matter. It could be anything. Okay, this is the effective federal funds rate, and you can see the impact of again, basically, if you look at it, it will track other short-term interest rates very much. If you pull up a chart of LIBOR, so we can actually pretend that this is actually LIBOR, although this is the effective federal funds rate. So the effective federal funds rate is the American equivalent. This is the policy rate. Okay, this is like the equivalent of the repo rate in India. So you'll see that it tracks other short-term money market rates. Like it will not be the same, of course. There's a spread, but the overall movement pattern will track the movement. If you pull up a chart of 1 month LIBOR or 3 month LIBOR also, it will look very similar to this. But of course, the scale is different because it will be a little bit higher than this interest rate. So anyway, if you look at this, and if you look at this, just pretend that this is the market price of something. And so if the market is here, okay, if the market is here somewhere, and you think that the market should be here, or maybe you started thinking that the market should be here at this point. Okay, when you're here, you thought the market should actually go up to this point, this level. Okay, here, you thought it would go up to here. And so you bought it here. But then after you bought it, the market kept declining. Instead of rising, as you predicted, it kept on declining. So there's got to be a point when, so what Keynes is actually trying to say in this quote, what he's saying is that, well, as the market declines, you bought it here thinking it would go back to this point, or this level, but the market keeps on declining, and yet you don't, you don't take heed of the market's movement, contrary to your views. What you keep saying is, well, the market is irrational. The market is irrational. By that, what you mean is the market is very far away, or very basically not equal to my estimate of fair value. Remember, most fair value estimates, other than classical, true arbitrage free valuation based fair values. Other than that, most of the fair values are actually subjective. So your subjective fair value, you thought it was here, and you bought it here, and then the market kept declining, and you keep saying the market is irrational because it's not moving towards, it's not near your fair value estimate. But your fair value estimate is different from anybody else's estimate. Now, there's nothing sacrosanct about your fair value estimate. So what Keynes is saying is, fine, your market is away from your fair value, moving further away from your fair value, and you're complaining that the market is irrational, but the market can remain irrational for longer than you can remain solvent, because the market is not obliged to follow your estimate of fair value, and it may keep on declining and declining. Even though it rises, it doesn't come back to your level, and then it keeps on declining and stays low for so many years. So by this time, you're basically bankrupt. Okay, you've lost your solvency. Remember, solvency is the ability to pay your debts as they come due, which means as the market keeps declining, we should write the definition of solvency. This is the legal definition actually. Solvency means ability to pay your debts, not just to pay your debts, okay, but as they come due. I hope everybody's following the global financial news and following the Evergrande crisis in China, because they've already now passed their the debt payment date. Now there's a 30-day grace period. I hope you guys are following all this, understand what's going on in global finance, because it's having an impact on the market, or at least the market is talking about it. So solvency means the ability to pay your debts as they come due. So on the due date itself, not after a renegotiation or some kind of a grace period or anything like that, on the day that they come due. So what Keynes is saying is that you can argue with the market all you want, but at some point of time you're going to go bankrupt because you don't have endless amounts of money. So essentially, you have to respect the market, because the market can remain irrational for longer. It can just keep going down and lower and lower, and just stay at a low level for a very long time, and it's away from your estimate of fair value. So therefore, you say it's irrational. But then the market has no obligation to be rational. So that's the point. So that's another important. This is a very important quote actually from somebody who is very much into the investment business, although he's a famous economist. So this also you should understand. Now the theme of all these statements is pretty similar. It's all based on the price versus fair value paradigm. People who operate according to that paradigm. And the message here is that the market is always right. So you have to assume that the market is always right, and you have to respect that. And this quote from Keynes is also very important, right? You should remember this. That basically all that this stuff is telling you is to respect the market. And if the stuff is going against, if you bought something here and you thought it would go there, but it keeps falling, at some point, like once it breaks a level like this, or some other kind of fundamental trigger, some reasonably quick response to losses, you need to keep your losses small. So you've got to cut your losses and give up on this idea, because otherwise you'll take, as they say here, you'll take the mother of all losses, okay, and then you can't even play anymore. So this is what we wanted to remember. So it's just generally not very sophisticated points, but these are very important points which you should understand, and not too many people talk about it in either on television or wherever else. So these are important points that need to be emphasized for your own protection. Actually, in the future, when you operate in the real world, they need to be emphasized for your own protection. All right. So let's go on to. I'll just do a check to see that the recording is happening. Yeah. Okay. So it is happening because there's a pause option. So we were on page 54. Okay. So these were the stocks that were very big in the days of the internet boom. Amazon had kind of just gone public at that time, around that time. It's one of the actively traded stocks at that point. Now, if you see this 1-year forecast, this is one of the reasons why in your project you've been asked to give a 12-month price target, but I've asked you something else, also to give some pain points, which is at what point your forecast is going to be wrong, which people typically don't. So this 12-month price target is typically the tradition among equity analysts. They give targets which are like 12-month price targets. But one of the things that equity analysts don't do is they don't give any kind of a stop loss kind of idea. It doesn't have to be a price-based stop loss. It could also be a fundamental information-based stop loss, like Facebook subscriber growth fails to reach 10%, fails to hit 10% 2 quarters in a row. That's not a price-based trigger point, but it's a fundamental information-based trigger point, which would lead you to sell the stock. So there should be some kind of a pain point element in equity research reports, but there isn't. So that's one of the, I think, a shortcoming of the equity research report. So anyway, so you can see some of these stocks. These are very big companies now, actually. Qualcomm, very big companies. This guy, the CEO of Qualcomm, was just interviewed on just a few weeks ago, I think, on Bloomberg Technology. Was talking about the chip shortage and the general strategy. There's a full interview, actually. You can look up Bloomberg Studio 1.0. There's a full interview with the CEO of Qualcomm. Very important company in today's age, because they make very specialized kind of chips. So yeah, so now he's talking about more examples of how people have tried to promote kind of quick and easy stock trading. And yeah, so, and again, the distinction between investing, I'll come to that later, but he's giving more examples of that. The January effect is one example. So this is actually has been quite well studied by academics and other market participants as well. So you can read a little bit about the January effect. Just read a little bit about it. I'll just let you read it and then I'll comment. So what causes the January jolt? Because people sell money losing stocks towards the end of the year to lock in their, to basically create tax losses. So if you have some realized, because taxes are typically levied on the realized net profit, so if you have some tax gains in the year and you have some money losing stocks, so a lot of people would typically sell the money losing stocks to realize the losses, and then you can offset those realized losses against the realized profits, and then you can actually lower your tax bills because your net profit gets lowered. So that's one of the things that people do. So in India also, if you look at Indian tax law as well, under Indian tax law, you can't, we make which I think is not actually a correct distinction, but they have done it anyway. So the government is king, so they can do whatever they like, even though it's not logical. So they call this speculative business. So if you're like a stock trader, they'll say that you're engaged in a speculative business. So under Indian tax law, your gains on speculative businesses can only be offset by losses in speculative businesses. You can't have a loss in other businesses which the government doesn't consider speculative and offset that against your speculative business profits. So this is something, I don't think it's a very intelligent way to approach it, but this is what it is. This is what the law is. But anyway, so this is what they do. So that's why what happens is, because of two factors. One is investors selling for tax losses towards the end of the end of the year, and also money managers also being reluctant to buy towards the end of the year to protect whatever performance they have. So therefore, there's less buying and there's more selling here. So as a result of that, the net selling pressure increases in December, and then eventually what happens is eventually basically when this pressure is relieved in January, then there is a January effect where stocks tend to rise. So what they have seen is that here. So if you have so there's some research done by a prof here from Rochester, where he's talked about this. These are the kind of effects that he has found. Now, what you have to note about this is that now this is a very common thing. Okay, so let me just make a comment about this here. So a couple of things. I'm just before I come to the brokerage part. Let me mention another thing actually. The page, we are on page 56. Yeah. So this is a study by William Short, okay, of Rochester. Okay, so let's just talk about this study. Okay, that's an important thing to understand again. How do you spell it? Okay, on page so this is like a under the January effect topic. Okay, there's a subtopic of the Short study. There'll be another topic of brokerage related costs that I'll come to later. So on the Short study, you can see that what he did. Now this is very typical. Okay, those of you, many of you have had to do. Oh, many of you have had to do these capstone projects in which you had to review a lot of academic articles. I think you've already detected by now that in many academic articles, this is basically the kind of research that they do. What they do is they take some data for a particular period like this. Okay, seems like a long period. There's no doubt about that. I'm not criticizing the long period, but the problem is that, and what they do is they find some basically patterns based on what happened in that period. Like here, the pattern here is that if you bought small stocks in December and sold them in January, you would have made so and so this, you know beating the market by 8.5% point or 4.4 points, etc., etc. And so then what they do is that they present this in a paper, talking about how, as if this is going to be true all the time. So this basic fallacy you should not fall prey to. That there are a couple of problems with these studies. First is that even for this period that they're analyzing the data, sometimes the statistical conclusions drawn from the data themselves are not correct. In fact, if you remember I just showed you that Philip Stock page from Berkeley, the stats professor. Once you start reading his textbook, or maybe it's in his profile, you'll find that Philip Stock is also saying that, as expert witness and as an academic, he has discovered that many academic papers have statistical conclusions which are not really correct. Okay, so there are two problems with this kind of study, typically. Okay, two problems with. We can write it with smaller case. I guess it'll look a little bit easier. Two problems. Okay, typically two problems. Okay, one is that the statistical. So you should look out for these things, because you should not be fooled by this. Statistical conclusions, even from the data set used, are sometimes incorrect or invalid. And this, I'm not saying it. Philip Stock has also mentioned it in his incorrect or invalid. So that's just, but I would say this is the smaller of the problems. There are typically two problems, two problems typically with these types of studies, which are very, very common. If you read academic journals, you see this is pretty much all they do in academic journals. They take some data for any given period, and the period is long. Okay, I don't criticize them for short periods. They take long periods. That's okay. And then they do some statistical analysis and they come out with some conclusions. So there are a couple of problems. Sometimes there are problems even. The statistical conclusions, even from the data set that is used, are sometimes incorrect or invalid. But the more important problem is that this is something that they completely fail to understand. Actually, I find it quite stunning. I guess this is what happens when you don't actually have any, when you never actually operate in the real world. You just write articles, and you read other academics articles. This is what happens, that you have no sense of the real world, that these are not necessarily applicable. This is what you should believe, that not necessarily applicable to any other period, not just periods. Okay, let's write like it this way. Okay, so the point I'm trying to make here is that these conclusions are not necessarily, statistical conclusions are not necessarily applicable to any other period. And if you remember why, and this is connected to something else I told you, mentioned to you earlier, if you remember. What is it? So let me first make the point, and then I'll ask you the question. Then you'll understand. Maybe you'll be in a better position to answer the question. So what am I saying here in my second point? The first one you understand. Okay, you'll find this confirmed by Stark as well. Now the second one is, what am I saying here? What I'm saying is that if you see how it's being presented here, even here it's being presented in that spirit, that if you did this if you bought it bought in late December, sold in early January, you'd have beaten the market. So for this period. Okay, so they do this analysis, but they present it as if this is always going to be true. Okay, But this is the problem here. What I'm trying to say is that these conclusions, even if we assume that the statistical conclusions are correct and the analysis is correct, okay, then this 8.5%, 4.4% for this period, this information for this period, none of this stuff is applicable strictly speaking. Okay, strictly speaking, none of these conclusions apply for any period other than the one being studied. You understand what I'm saying here? These conclusions are strictly speaking necessarily applicable only to this data set that is being studied. There should not be, nobody should believe that this will necessarily, when we are talking about market data, when we're talking about financial markets or economic data, okay, if you're talking about other things like hard science, that's different. I'm not talking about hard science, I'm talking about finance and economics. In finance and economics, nobody should believe that these conclusions apply necessarily to any other period. These are okay for this period, this data, but who knows what's going to happen in the future, right? That's what I'm trying to say here. So this is something which is completely missed by academics, and so this is something that you should be aware of if you want to be protected in the real world. Because at the end of the day, you have to be you don't live, you're not going to live your life in journal articles. You will have to operate in the real world. So you have to understand how the real world works, and therefore you should believe this, that statistical conclusions from the data set used not necessarily applicable to any other periods. This is an important point to understand, otherwise you can get into trouble. Now, this thing that I said, what does this remind you of? Does it remind you of any other concept that I discussed recently with you? I don't know if my question is clear. Does it remind you of any other concept which I have recently discussed with you? This kind of, my second point here. Anybody? Let's see if people can even hear me. Let's look at participants. Let's ask, who should we ask? Let's ask Kirit. Kirit, do you understand what I'm saying? What happened? Kirit is sleeping. Okay, let's ask Ritvik. Ritvik, are you following what I'm saying? Have you understood my question? Ritvik is also sleeping. Who should we ask? Let's ask Ruchi. Ruchi, did you understand my question? No? What happened? Somebody raised their hand. Kirit has raised his hand. Yes, Kirit?
Yes, sir, you called me.
Yeah, I called you, but what did I ask you? Did you understand my question? Did you hear
Sir,
me?
your voice break. I just heard my name only.
You heard my name. My voice is not clear. Other people are also having difficulty with my voice. Okay, let's not waste too much time then. Let's not waste time. Let me just tell you what the concept is. That if you remember here earlier, I discussed. Yeah. So I'll just grab this again. So you have to understand this. So this is what I'm trying to say here. Visually, let me remind you again. This is what I'm trying to say. That it's like, because there is non-stationarity in the market. Remember, this is not anything I made up. This is actually the movement of the oil price. So you can see now this is happening on many scales. Okay, on many degrees of magnitude. This kind of differences are happening all the time in the market. So the point I'm trying to make is that typically you might have drawn your conclusions based on this kind of a data set. But then you could go into a new regime which is like this kind of market movement, which means all your calculations based on historical data will go for a toss. That's what I'm trying to say here. Be very aware of how the market is constantly shifting and changing. So therefore, don't fall in love with any kind of study which tells you that, okay, this happens, 84.4% outperformance. This is not, you should be very clear in your mind about this point, that the statistical conclusion from any of these kind of studies, which is very common in academic finance, and many people in the market also try to follow those studies sometimes, or they, because maybe it serves some of their interests, so they would quote that kind of study. But you should never forget this principle that in finance and economics, if you have done some analysis based on some data set, then these conclusions are strictly speaking applicable only to this period. Outside this period, God only knows what will happen. Maybe it'll work, but maybe it won't work. So there's no guarantee that it'll always work. So that's what I want to emphasize, because this is not sufficiently emphasized. This is not frequently discussed, because most people, I mean, maybe not even are not even aware of it. So therefore, this is something, but it can have a huge impact on your ability to protect yourself in the world of investing. So if you're not fooled by this, then you will always be cautious, and you will understand that things could start to fall apart at any point of time the moment you go outside this period. That's all I'm trying to say here. These are important things to be and this is basically, again, reinforcing the idea of non-stationarity. The very important idea that time series data on markets, and not just markets, okay, let me just call it asset prices. Market means asset prices. And also economic variables. If you look at industrial production, that will also have the same feature. We don't have that high frequency, with that kind of high frequency data on industrial production, or even on GDP. We don't have that kind of high frequency data that we get on asset prices, because these are trading all the time. So these things come out like once in a quarter, once in a month, maximum once in a month, or jobless claims come out once a week. So that's about as frequent as it gets. So as highly granular as it gets. And economic data, because basically asset price movement is nothing but speculation on what's going to happen to economic data. So basically both are driven by expectations of investors. So even economic data is driven by expectations of investors. So therefore, like whether somebody's going to set up a factory, these are all driven by, you don't have perfect information, because all your NPV analysis that you do is all based on forecasts. So what is the value of your forecast? It doesn't mean anything actually. It's just a forecast. You could easily be wrong, but people still invest based on that kind of projection-based NPV analysis. So people still invest, and that's how the world works, and that's why economic data is also non-stationary, because there's all kinds of information shocks that keep coming, and the market behavior keeps changing. So therefore, this is something that you should understand, that very important point, that it's not applicable everywhere, only for the data set being studied. Okay, let's look at the second point about this point is January effect, the phenomenon known as the January effect. Okay, the second point that he's made, which is also important to understand, that I'll mention the point again. I'll mention the point first, and then I'll write it. Sometimes you have other transaction costs other than brokerage, which is basically stuff like exchange fees and all that, which usually the broker himself will charge, but it will be written not as brokerage, it will be written as exchange fees. Like you have securities transaction tax in India. When you trade, you have securities transaction tax. So those are actually not brokerage fees, but these are these are actually taxes, of course, but these are part of your larger concept of transaction costs. So brokerage is a type of transaction cost, but there are other transaction costs like taxes and exchange fees, etc. So brokerage and other transaction costs should also be factored into pre-positioning risk analysis. Okay, I'll explain what this means. Pre-positioning risk analysis and ex post performance evaluation. See how smart Google is. Okay, pre-positioning risk analysis. So basically, let's read what Graham is saying. Okay, so what is he saying? Well, of course, here is that there is like as more and more people try to buy stocks in December and sell them in early Jan, the decline in December gets reduced, and the rally in January is also reduced because people are selling into the rally. So what he's saying is here, the Plexus Group, which is an authority on brokerage expenses. So, and if you especially try to do it in small stocks, he's talked about the transaction costs can be much higher. This transaction cost can be, so costs of buying and selling is just the transaction cost, he's not talking about the actual price gain or loss. So the total cost is actually just the transaction cost, which can be up to 8% of your investment. So what he's saying is, by the time you're done paying your broker, all your gains of the January effect will melt away. So the point here, the message is that brokerage and other transaction costs should also be factored into your pre-positioning risk analysis and ex-post performance evaluation. He's talked about really the ex-post part, that here you have this analysis by Stewart talking about, I don't know if Stewart, I guess he would not have taken into account the transaction costs. That's why they're mentioning this, because I have not read this paper. But he's talking about, let's say that he's not taken into account the transaction cost. And so he's beaten the market by 8.5 percentage points. But if you're paying like 8%, if you're paying 8% on your transaction costs and just your brokerage, then your entire gain is wiped out. So you're not really beating the market. So the point here is basically this, that so he's doing this as a ex-post analysis. Okay, so this applies to ex-post performance evaluation, but even in your pre-positioning risk analysis, if you see where we discussed in your calc file I was showing you the other day, that how much risk to take, you should also take into account. Maybe we can open it here and see. We'll wait for it to open. But basically, pre-positioning risk analysis means that before you take the position, as I mentioned to you, that we were considering an investment here where we had this was the proposition being discussed, that we discussed something else here actually. Yeah, so there's entry price, we were talking about Facebook, I think. So entering a short position in the S&P 500, the SPY ETF. So you enter a short position at 440 and you're going to exit at 455. So your loss is $15 per share. But what you should add here is, now when you try to incorporate my advice here, that now there's a further higher level of the further refinement of this analysis. So we said this is how you decide the number of shares to buy. But there's a little bit more refinement that you can do here, because initially we discussed it with no transaction costs. Now when you have brokerage and other transaction costs, what you should do is, this is the actual price hit from the entry and exit, but you also add the transaction costs. So if you have, so this is what I'm saying, in the pre-positioning risk analysis, because this you're doing before you take the position. Because before you take the position, you know where you're entering, you know where you're exiting, and only thing you don't know is how many shares to buy. But you also know how much money you're willing to lose. In this example, we decided that we have $100,000 in capital, so we will only risk $1,000 to be on the safe side, and we can reduce okay, that's our risk capital. So we will only risk 1% of our risk capital per trade. And so we have all this information. Okay, what we don't know is how many shares to buy. So earlier we just did this calculation of number of shares by dividing the available amount of money to lose on that trade, which is $1,000, where we can afford to lose on this trade. And so we divide that by 15, which is the per share P&L. But actually what you should do is, you have to add this 15, okay? To the 15, you have to add also the, when you look at the number of shares that you're buying, so basically you look at the total brokerage cost of that transaction, and you have to also look at your per share brokerage. So you have to add the brokerage as well. So in your risk allocation per trade, this should also be able to take care of your brokerage, all your commissions and other exchange fees and taxes and all transaction costs. So this one doesn't take care of transaction costs, so you have to additionally take care of transaction costs, and only then can you decide. You have to convert the transaction cost to a per share basis, and then you have to divide, you have to add that figure here. Okay, so it's a little bit more than 15, and then you add that, and then only can you figure out how many shares to buy. Okay, so this is something that that's what it means in this kind of this point about the transaction costs. Okay, that your per share, your pre-positioning risk analysis also has to reflect the importance of transaction costs. So it should be absorbed by your risk capital. But later on, then you don't have a surprise. If you're doing it this way, then you'll never have a surprise, because you're losing a controlled amount of money on each trade. And all the costs, all transaction costs should be factored in as well. Right? Okay. Now, let me go to page. Okay, let's continue with this page here. See what we have. Again, he's mentioning about other things. So these are just do what works. These are all things which Graham is talking about with great contempt. That, yeah, he's talking about in Money Man. This is just a story actually. That somebody mentioned this, took out a patent. So this will keep on happening, because people need to make money, so they need to promote their funds. So they'll come up with all kinds of gimmicks to promote their funds. It's basically what you see in the world of business all the time, that people are coming up with different types of gimmicks to make people buy their product. So he launched a bunch of funds, but eventually the funds did not work. So they've given some data here, you can look at that. But basically these funds did not work out well. They didn't outperform, they actually underperformed the market. And okay, so then there's another one, the Motley Fool, which is still there actually. The Motley Fool is a website that keeps comment. It's not really that bad actually. Sometimes they have some good information. So it's a useful website to read. You have this kind of a strategy that they talked about. Again, this is a specific strategy. You don't have to worry so much about it. But I mean, understand that people will. There are various strategies, okay, and there's no guarantee that any of those will work over the long term. So you have to have a certain, yeah, all this stuff which. So again, now he's mentioned this strategy. Graham is not happy about this. So he's saying that it's not meeting Graham's definition of an investment. Thorough analysis, how could he? This is just his criticism from his own perspective, that the lowest price stock should be bought, etc. And no diversification. But then Buffett himself doesn't really believe in diversification, so it's not really not something that you should take that seriously. Then how could a portfolio of 4 stocks? Again, the same problem. Most of the good investors actually believe in highly concentrated holdings, not in in diversification. So therefore, this is typical. In a way, is a little bit academic to keep talking about diversification. So here. You can just read these yeah. So this is basically that if you look at a lot of data, you will see a large number of patterns. That's true actually, because human beings have a tendency to detect patterns. So yeah, so here what they're saying is that this, if you look at this, yeah, so this is basically just luck. It's just luck that some things happen in a particular period, and you could actually just build a portfolio like that. And there's also, you might have read this somewhere, that some people have said that if you get a monkey to throw darts at a bunch of tickers, stock tickers, and you buy the stocks which the monkey has hit with his darts, you may actually do better than, or you would do just as well as any other professional mutual fund manager. So this active stock picking, these kind of stories are told by people who believe in passive investing, in the market efficiency and things like that. So they basically give you this kind of story, and they say that there's no point in investing in actively managed mutual funds. Right? Yeah. Now, stocks do well because the businesses do well. Nothing more and nothing less. But again, you have to see, that's why I made a comment about this page 59. When you say this, um, okay, look at this statement. Stocks do well, stocks do well because businesses do well. I've just paraphrased it. Okay, now this reminds you of what? If you believe that stocks do well because businesses do well, this implies what? Okay, business is basically kind of like semi-strong, kind of semi-strong firm efficiency. Okay, um, okay. So what he's saying is stocks do well because businesses do well. This would imply that the market is always efficient, or that departures from efficiency are short-lived. Okay, this again would go against departures from efficiency are short-lived. Okay, departures from efficiency are short-lived. So the market is all that, but this is not really true. This departures from efficiency is short-lived is not really true, as I've shown you, because even if you look at the statement by Keynes, the market can remain irrational, because when it's irrational, it's also not kind of efficient, because according to you, it's not reflecting the information that is available to calculate the fair value, so it's not really efficient. So this kind of departure can easily happen. If you look at this, you buy something here thinking that it's going to go up to here, but actually it keeps falling and falling, and for years and years it remains away from fair value, right? So this can easily happen in the market. This is fairly common depending on where a particular investor has estimated the fair value to be. So this, therefore, what he's talking about is basically this, that the departures from efficiency are short-lived. This is not really true. Okay, this basically, when he's saying stocks do well, so in a way, departures from efficiency are short-lived. This is not really true. Okay, not true. And in fact, value investing also relies on this not being true, if you really see. So Graham in a way is contradicting himself, because if stocks always do well because the business is doing well, then where is the question of buying things at a deep discount to fair value, which is the high margin of safety? That means you will never get those kind of stocks, because the stocks are always more or less efficiently priced. That if the business is doing well, then the stock is doing well. But what you really have in value investing is, you can write this as, so I want you to understand these things, that when he's mentioning certain types of ideas, that what is the implication or what is the implied belief behind that kind of a statement, and whether that implied belief is consistent with his other statements. So there seems to be a consistency problem here, that it seems inconsistent with the value investing idea. Okay, I think if you look at market frequently I'll just finish this point. Yeah, the point I'm trying to make here is that Graham seems to be, so you should understand these points, that when you make certain kinds of statements, the implied belief behind that statement is probably not consistent with the other implied beliefs that you have demonstrated earlier. So if you look at this, it seems inconsistent with the value investing idea that the market frequently sells off sharply and remains in such uh, a at a deep remains at a deep discount to fair value. Basically, that's what enabling the value investor to buy it with a high margin of safety. Do you understand that? So the only reason you're able to buy with a high margin of safety is because the stock is trading at a deep discount to fair value. And if the stock is trading at a deep and stays there for a fair bit of time, allowing you to do your analysis and also buy it later. So if it doesn't stay, if it stays there for long enough like that, then it's not really consistent with the idea that the market is always efficient, which is what he's implying when he's saying stocks do well because businesses do well. Okay, so I've taken 1.5 minutes extra of your time, all right, to buy it with a high major margin of safety. So I just wanted to make sure that you understand that some of these statements are not really consistent with each other. All right, so we'll end it here, and so the class is dismissed. You guys can leave, and those who have questions can stay back. And end of today is what? Today is 25/9. Anybody has any questions? Yes. I notice these days people don't ask any questions. What happened? Are you guys getting bored? Nobody's asking any questions these days. In-call messages. Okay, now we have to mark Aditya present. But before we come to Aditya, we will stop the recording. If anybody has any questions? No questions? Okay, all right. So we'll stop that. So we'll stop the recording. And okay, let me just stop the recording here. 1 minute. Any other latecomers? Attendance looks like we are giving out. 1 minute. Let's open the main window and make sure that, yeah, it got most of it. So I'll just stop.